Hello, everyone. First of all, I apologize for the setup here. It's not a professional studio. I am recording this from my home office, and the lighting is not perfect, but it will get better with time, I promise. My name is Serge. Welcome to the Community Nomad series here that we have put together for you. Thank you for joining our group. I encourage you to ask questions and engage with each other to build the community, get some value from the community, because it's only as strong as the investment that we put in together on this. We are all like minded folks who dream of either living, working, retiring abroad permanently or partially, or being global travelers, and that all that it entails, because it involves a lot of different rules in this rules-based society. Are you considered an expat? Are you considered a resident, a non-resident? Where do you pay your taxes? A lot of these questions come up a lot. So this is the first episode. We plan to do these every 2 weeks, and then on alternating weeks we're going to do the Q&A sessions. So this first episode, we're just getting started with the basics, because before anyone can actually plan a move, they need to know how the CRA actually defines residency once you leave. So let me just state that today we're going to be talking about residency, tax residency or not tax residency. The next part of this session, we're going to be talking about Portugal. Not because, that's where everybody wants to go. Every 2 weeks, we're going to talk about a different country, but giving a little bit of flavor for the destination and talking about, the not just the practical part of things, not just the financial part with the taxes, but also the logistical, where to move and how to move, and the emotional that nobody talks about, because the emotional can put a kibosh on all the best laid plans, right? Like, you can be planning and whatever, and then something in your mind is just keeping you back, or something is not right, or you just feel some fear, or you do move and you don't integrate properly. And these are real things that have happened, right? How many YouTube videos are there about people who moved to Spain, to Portugal, to Costa Rica, and then you see a video saying why we left Costa Rica and came back to Canada, what they don't tell you. So this community is, hopefully, my vision is that we are going to be here for each other to answer questions in a true and honest voice, and not in a way of saying, like, oh, don't worry about it, just do it like this, because we're all different human beings. So let's be collaborative about it. Okay, without further ado, I can be a talker. Let's get right into it. So, where was I? Okay, this is a report video that I'm going to be talking about exactly what the CRS says and how it applies to residency. There are 4 residency categories that the CRA works with. Let's go through each one. First, why residency and not citizenship? A distinction that matters a lot. Canada taxes based on residency and not citizenship. Unlike other countries like the US, where citizenship alone creates a tax obligation, Canada's system asks a different question. Are you a resident of Canada for tax purposes? Yes or no? That answer determines what you owe. Full worldwide income, partial income, or none at all, depending on which category you land in. So this isn't just a technicality, it's the entire foundation of what a departure looks like financially. Here are the 4 categories. Let's go through this first one. Factual resident. That's the category 1, factual resident. This is for people who physically left Canada, but the CRA still considers them resident because of what are called residential ties. The CRA actually splits these into 2 tiers, primary ties and secondary ties. Now, primary ties are the heaviest weighted, and those are a home in Canada, even if it's currently rented out, a spouse or common law partner who remains in Canada, or dependents who remain in Canada. So for example, if you get a contract to work in Spain, but your spouse stays at home in Canada, that would be a significant primary tie that would still make you a factual resident. Now, secondary ties, and these carry less weight individually, but the CRA looks at them as a group. Canadian bank accounts or credit cards, investment accounts, a driver's license, provincial health card, or Canadian passport, membership in Canadian professional or union organizations, and a Canadian motor vehicle registration or a Canadian mailing address. So one primary tie can be enough on its own for the CRA to classify someone as a factual resident. But secondary ties usually need to stack up in combination to have the same effect. I know, it can be super confusing. Now, I am working on infographics to clearly and quickly, you can just download it instead of re-listening to this whole video where it'll explain the two-tier breakdown, primary versus secondary ties. It'll be a clean visual. If it's not already here, it'll be here in a few days. Clean visual that will explain what the actual model is, that this is for factual residents. So, factual residents file a full Canadian tax return and report worldwide income, the same as someone who never left. And this category is common for people who are outside of Canada temporarily, they're on a work assignment, an extended stay abroad with a return date already planned. All right, let's move on to number 2, non-resident. So non-resident, to qualify here, the CRA generally needs to see that significant residential ties have been severed. Cut, gone. That includes selling your home, or in some cases, renting it out, although renting alone isn't always sufficient. It's weighted alongside other ties. That includes your spouse and dependents are relocating with you as well. You've canceled your provincial health card and your driver's license, or you've converted your Canadian driver's license into the driver's license of the country you've gone to. Establishing new ties in the destination country, like leasing an apartment, a local bank account, or a local ID. So once non-resident status is established, tax obligations now shift. Worldwide income is no longer taxed by Canada, but Canadian sourced income still is. Rental income from Canadian property, Canadian investment income, typically taxed through withholding taxes, which we'll get into, I'm sure, in the Q&A or future videos, and generally at a flat rate that the CRA sets for non-residents on that category of income. There's 2 procedural points worth flagging here. And the first is that the year someone leaves, they file what is called a departure return, and that return has to reflect a specific date. Bear in mind here, I want to add here, even though there will be also in the notes here, disclaimer, this is general advice and not specific to you. I am not an accountant, but I've done the research. So I am a financial professional, but everything here should be taken in its own context of how it works for you. And we definitely encourage you to speak with your own financial professional or tax accountant. By the way, we've got a couple that are in the group here. So if you ask the question, I'm sure that they'll be responding, or you can set up a separate telephone call. All right, let's get back to this. Where was I? Oh yeah, the year that someone leaves, they file what's called a departure return, and that return has to reflect a specific date. The actual day residential ties were severed. That date matters because it's also the date used for the second point. The second point is deemed disposition, and this infuriates so many people. Trust me, I know. I've got a TikTok channel. I talk about this, and it goes to the roof. On the departure return, the CRA treats most property as if it were sold at market value on that departure date. And this can trigger capital gains tax on things like non-registered investments, even without an actual sale taking place. There is a mechanism to defer paying that tax until the property is actually sold by posting adequate security with the CRA but the disposition itself still gets reported that year regardless. This is dense enough that it can have a separate report on its own coming later in the series, and it'll be a good one. What a lot of people don't know is that not everybody's affected by this. Like if you don't have non-registered assets or other properties, most likely you'll be fine. But again, let's leave that to a later date. Now, there's also a form worth knowing about here, the Form NR73, Determination of Residency Status. Now, this is not mandatory, but it's the form people use to formally request that the CRA review their specific facts and confirm residency status in writing, rather than relying on self-assessment alone. Everybody I've talked with, professionally wise accountants, say this is not a form they recommend that you fill. And not only because it can be biased or it can be answered in different ways. Even if a husband and wife are doing the exact same thing, they send it in, they'll get two different responses. But it is a form that I want to highlight here in case you want to go that route. Talk with an international tax accountant or professional about this. Now, category 3 is deemed resident. This applies to people without significant residential ties to Canada, who are nonetheless classified as resident because of a specific rule. The most direct example are government employees stationed abroad, including members of the Canadian Forces and certain federal government workers posted internationally. There's also a rule that applies more broadly, the 183-day rule. If someone spends 183 days or more in Canada within a calendar year, the CRA can deem them a resident for that entire year and tax worldwide income accordingly, regardless of intent or ties elsewhere. Notably, this counts total days present in Canada in the year. It doesn't need to be one continuous stretch. So several shorter visits that add up past that threshold count the same as one long stay. For anyone who's left Canada but returns for extended stretches, like family visits, remote work from a Canadian property, day counts become directly relevant to residency status and worth tracking deliberately rather than estimating after the fact. So now let's move on to category 4, the deemed non-resident. This one involves tax treaties. The scenario is that someone maintains residential ties to Canada, potentially enough to qualify as a factual resident, but they also meet residency criteria in another country under the country's own domestic rules. Where Canada has a tax treaty with that other country, the treaty typically includes a tiebreaker provision. The standard order it works through is where the permanent home is located. Then, if that's ambiguous, both countries where the center of vital interests sits, meaning where the personal and economic relationships are strongest, and then a habitual place of residence, and finally citizenship. If the earlier tests still don't resolve it, then it'll go to citizenship. If the treaty assigns residency to the other country, Canada treats that person as a deemed non-resident from the point forward, even if they'd otherwise qualify as a factual resident under Canada's domestic rules. Tax treatment follows non-resident rules going forward. This is the most treaty-dependent of the 4 categories, and since outcomes vary by country and by the specific treaty language, Canada's treaty with Portugal won't read identically to its treaty with, say, Mexico or Thailand. All right, now let's do a couple of practical add-ons. Part-year residency and account impacts. These are worth knowing since they come up almost immediately after residency status changes. Part-year residency, the year someone actually leaves, they're typically taxed as a resident for the portion of the year before departure, and as a non-resident for the portion after. Income, deductions, and credits generally get prorated to reflect that split. It isn't a full resident year or a full non-resident year. It's a blended one. Registered accounts like TFSAs and RRSPs don't get shut down automatically when someone becomes a non-resident, but the rules around them do change. TFSA contribution room stops accumulating for non-resident years, and any contribution made while non-resident is subject to a monthly penalty tax until it's withdrawn. RRSPs can generally stay open and continue growing tax deferred, but withdrawals as a non-resident are taxed differently. it's not that usual, 10%, 20%, 30% based on the amount you're taking out. It's typically a flat non-resident withholding rate instead of the marginal rates. So to summarize the four categories, factual resident physically means physically outside Canada, but residential ties are strong enough that the CRA still considers the person resident, and full worldwide income is taxed. Non-resident, significant ties have been severed and new ties established elsewhere, and only Canadian-sourced income is taxed. Deemed resident, specific rules such as government postings or the 183-day threshold classify someone as resident regardless of ties. And 4, deemed non-resident, a tax treaty tiebreaker assigns residency to another country, overriding an otherwise factual resident status. Now, a few things worth noting from this research. Residency status isn't determined by a single factor. It's assessed based on the combination of ties, home, spouse, financial accounts, ID documents, day counts, and the classification isn't always static. It can shift based on decisions made before and during a departure, like the departure return and deemed disposition rules touched on earlier. That's the full breakdown of the 4 main CRA residency categories as they currently stand. Where someone lands in this depends entirely on their specific facts: home status, family location, day counts, treaty country if applicable. This is just the starting point. If something in here raises a question specific to your situation, that's exactly where our week 2 sessions or Q&As are for. Bring it to the Q&A, open to everyone, any relevant question. Speaking of which, I can share some news. I've garnered confirmation from a Portuguese law firm that will be joining us, this community, very soon, and they may even be available for our very first Q&A next week. So if Portugal is on your radar, that's a good one to save your questions for. That's the research for this part, which took longer than I thought. It's about 17 minutes rather than 10, but I promise it will get better, and I hope this was valuable for you. Put your questions in the comments. And let's move on now to the next part, the logistical pillar, and let's focus on Portugal. And I've developed this topic specifically for Algarve versus Lisbon. Here we go. We are back. Portugal. Love it. Been there. I've been to Algarve, I've been to Lisbon, I've been to Porto. Portugal is a destination people have thought of. I'm not sure how many in this community are yet looking at Portugal, but hey, they got the short end of the straw as being the topic for the first country. So we're rolling with it. Every 2 weeks, we'll be talking about a different country and a little bit of different things about it. And I'm actively looking and searching all the time for people who have moved to Portugal who want to be interviewed for this community and for our channels. So if you know anybody, send them our way. Portugal does come up a lot. So let's see what actual logistics we can pull. Specifically comparing 2 regions people ask about most, the Algarve and Lisbon. Same country, 2 very different day-to-day realities. Both regions fall under the same national visa pathways, most commonly the D7 visa. For people with passive income like pensions or investments, or the digital nomad visa, for that would be for remote workers with a minimum monthly income requirement currently set by the Portuguese immigration authorities. Now, before either visa is submitted, applicants generally need 2 things sorted first. And that would be a Portuguese tax number called an NIF and a Portuguese bank account. Most consulates want proof of one or both alongside the application. The application itself runs through a Portuguese consulate before arrival, then converts to a residency permit through Portugal's immigration authority after arrival. We'll be creating an infographic for this as well, so look for it in the community. The Algarve now is the southern, let's talk about that part. It's a southern coastal region. Think like towns like Lagos, Faro, Tavira. I hope I pronounced those right. Don't bash me if I haven't. It's the more established expat corridor with a large existing English-speaking community, mostly retirees and remote workers. The cost of living there runs lower than Lisbon, particularly on housing. Rental prices in smaller Algarve towns are meaningfully below the capital, and healthcare access includes both the public system, which residents become eligible for, and a well-developed private clinic network aimed at the expat population. Many newcomers carry private health insurance during the initial residency period before public system access is fully established. The trade-off, it's quieter in Algarve, it's more spread out and less connected by public transit, though. A car is functionally necessary outside of the main towns. Now let's take a look at Lisbon. Lisbon is the capital, and logistically, it's a different experience entirely. Trust me, I've been to both. Higher cost of living, particularly rent as a higher cost of living, which has risen significantly in the past several years due to demand from both expats and domestic buyers. Where it has not gone up, honestly, anywhere. In exchange, residents in Lisbon get a major international airport. They have extensive public transit and the largest job market in the country for anyone still working locally or hybrid. Lisbon also has the largest concentration of English language services, international schools, English-speaking legal and accounting firms, and a much larger population of recent expat arrivals versus the more established Algarve community. A particular note for either region is that a Canadian driver's license isn't automatically valid long-term. Portugal they do have a reciprocal agreement with some jurisdictions for license conversion, but where no arrangement exists, a local road test may actually be required, and it's worth checking based on which Canadian province issued the original license. So in summary, the actual trade-off comes down to this. Algarve offers lower cost of living, an established retiree-heavy expat network, and a slower pace, at the cost of car dependency and less infrastructure. Lisbon offers higher costs but more services, better transit, and a larger job market for anyone not fully retired. Visa pathway is identical either way. The decision is really about lifestyle and budget, not paperwork. And this is exactly the kind of thing our Portuguese law firm contact will be able to speak to in more precise details once they join. I hope that you enjoyed that. If you have questions or if you want to shout out which country you want us to talk about next or you have experienced in, let us know. And let me know if you're interested in being interviewed about that or if you know anybody who wants to be interviewed. It's all best for the community to get all this information from firsthand experience. That's the best way. All right. Let's go to the last part, the emotional pillar, and we'll tackle that one next. Okay, I think we're back. Hopefully I've been recording all this with a microphone. It has happened that I didn't once before, and I had to redo the whole thing. But I think I see my mic is listening to me. Hopefully the sound quality is good. Hey, we're growing. We're growing and we're learning. Third pillar. Like I said, there's 3 pillars. Maybe I haven't said it, but there are 3 pillars to moving abroad or considering the move. Financial, obviously, you want to know if you have enough money. Logistical, how do I do it? What visas do I need? Do I move my stuff and how do I move my stuff? Things like that. And finally, emotional. And that's what I want to talk about right now. It's the identity shift. I want to talk about this because it doesn't show up on CRA forms. Are you ready emotionally? Or any visa applications. If we give you this visa, are you going to be finding friends easily or learning the language or fitting in? Here's what is not talked about before you go. You spend years being someone in Canada, someone's colleague, someone's neighbor, the person at the coffee shop who knows your order, and then you leave. And all of that, poof, gone. Not gradually, overnight. For some people, That's the whole appeal. I get to be someone new, a blank slate. Nobody there knows your history. Nobody knows your reputation, your past mistakes. You just get to start over. But a blank slate cuts both ways. It also means nobody knows your content, your context either. You're not the guy who's been doing this for 15 years anymore. You're just a new person, and you have to rebuild that credibility, that comfort, that sense of being known from zero. It's not a bad thing, but it is a real thing. And it's worth naming before it hits you. Now, the people back home, that's the second layer to this. That's not easy to get through, but it is easy to miss going in. The relationships you leave don't stay frozen in place. Life in Canada keeps moving on without you. Birthdays, promotions, small daily things. And the people there are living a version of their life you're no longer inside of. That can feel lonely to you. That's not anyone's fault. It's just distance doing what distance does. Video calls can help, but they don't fully replace being in the room. And the timeline that you may not know about is that if you talk to enough people who made this move, a pattern will show up. The first few weeks are like a vacation, a honeymoon. Everyone's new. Everything's new. Everything's exciting. And somewhere around month 2 or 3, it can flip. The novelty could wear off, and it just might seem like a very long holiday, and you want to get back home. What's left is just life, except harder because it's in a language that you might not fully speak, without the people who used to make hard days easier. And that dip is normal. It's not a sign you made the wrong call. It's just a part of the process that doesn't make it into anybody's highlight reel when you see on YouTube about living in different parts of the world. And here's what I'd like to say to anyone in that window between deciding to go and actually going. The financial and the logistical pieces are the ones you can plan for. Spreadsheets and visas and tax returns are all knowable in advance. The identity piece isn't like that. You don't know exactly who you will be on the other side of this until you're standing in it. And that's not something to fix ahead of time. It's just something to expect. We're going to come back to this thread over and over again through identity segments, the loneliness, the rebuilding, the reverse culture shock on the way back, if that ever happens. This is just the first mile marker. I hope you found value in this. Please talk about this in the comments, ask questions, and I look forward to seeing you in the Q&As or the next session. Have a good one. Plan accordingly. All right. See you then.